Good evening, everyone, and I welcome you to ICICIdirect Investonomics Live. I am Anupam Guha. I head the private wealth business at ICICI Securities. In fact, we are one of India's leading investments and a wealth management company. ICICIdirect Investonomics is a flagship platform, and through our live sessions, we bring in market experts and thought leaders. Today, we have a very special guest amongst us. It's my pleasure to welcome Mark Mobius. Mark, how are you doing?
Thank you. It's a pleasure to be with you today.
Thanks. Just to also introduce our investors to Mark. Mark, knows no introduction. In fact, he's a veteran emerging markets investment expert with, in fact, more than 40 years of experience. He's the founder of Mobius Capital Partners. Mark has actually received numerous industry awards, including being named one of the Bloomberg Markets magazine's 50 most influential people in 2011. Apart from his investment expert, he's also has been an author, wherein he's written two very famous books, one on investment for good, and the second on the inflation myth and the wonderful world of deflation. Mark, so let's get going. So Mark, in fact, very recently, we heard you talk about the Indian market on a 50-year rally, right? And in fact, you've increased your emerging markets allocation with special emphasis on India. Our investors would be quite keen to understand your perspective. Over to you, Mark.
Well, the wonderful thing about what's happening in India is that the country is now on a growth trajectory, which I believe will continue for quite some time. Now, compared to China, of course, India is starting from a lower base. If you look at things like per capita income and so forth, so the opportunity for growth is much, much greater than in India, than in China. China, as you know, was growing at 10% in 2010. Now it's growing more like 5%. And of course, that's because the size of the economy has grown so much. In the case of India, India is where China was maybe 5, 8, or 10 years ago. And now we're seeing an incredible surge of growth. And of course, that's reflected and predicted by the stock market. The stock market is a predictor of economic growth. And so we can see it makes sense for India to have a very bullish market environment, stock market environment.
Yeah. So, Mark, I mean, while you spoke about it, I think from a long-term perspective, the Indian growth story looks quite intact. But the global markets are roiled with, the outbreak of the new COVID variant, Omicron, right? It's all over the news. Also, if you see off late, FIs have sold close to 7 billion in the Indian markets since the month of October. In fact, today also the markets are down. So do you think that this can really lead to significant drawdowns and derail the current market uptrend that we see in India?
Well, as you know, last year when we had the first scare of COVID, the markets came down by 50%, 60%, so forth in February, March of last year. And since then, there's been an incredible bull market, not in all countries, but certainly in India. And the reason for that is that people have pretty much ignored the COVID situation and gotten on with their lives. And business continued. In some cases, businesses prospered as a result of the COVID situation. Now, with a new scare, the public will probably not take it as seriously as they did the previous scare last year. So I think that, yes, there may be a correction. We're seeing a correction in some markets, but I don't think it'll be a major, major bear market because of people have become inured to this whole business about COVID. They know that there'll be continuous new variations, new factors coming in with COVID and that kind of thing. And after all, every year we have a flu epidemic around the world, and people will get used to this kind of situation.
Yeah. So market from an from an Indian standpoint, right? The earnings have been extremely strong. Be it last year when we looked at closer to 20%. This financial year, which is financial year 22, there is a consensus that maybe the earnings are stronger, maybe at 25%, right? While in the last maybe 2 quarters, right, we've seen some bit of moderation in the margin, right? So with the global commodity prices pulling off, correcting by almost 15 to 20%, be it industrial metals, be it crude, do you think that the earnings trajectory can get a big leg up from here, especially in sectors like consumer, cement? Maybe your views on that?
Of course, the key commodity would be power sources. That includes oil, coal. That's where we have to look to see where the impact will be in the economy. But as we've seen in the past, yes, initially the market tends to react to higher oil prices or higher coal prices, but it's usually temporary. Doesn't last very long. Because if you look at the percent that energy costs figure into the earnings of companies, you'll find that for most cases it's quite small. It's not a big factor. So even with companies that are in the industrial area that depend on raw materials like steel, copper, etc., we find that the impact is temporary, simply because the percent, as I mentioned, of their costs are not that big of these commodities. And secondly, they're able to raise prices. If they're a good company, they can raise prices in line with the higher costs. So I don't think it's going to be a big impact in the fact of Indian equities.
Okay. When we look at the government capex, right? Government capex has increased from 1.6% of GDP to now almost closer to 2.5% in the last couple of years, right? So how do you see the infrastructure sector to perform going ahead? Do you believe that we are entering that phase of 2003 to 2008 when you had the NDA government at that point of time, where we saw a massive growth in the cycle in the infrastructure side?
Well, I think the Indian government could increase its spending on infrastructure, but it's doing a very good job in spending, on infrastructure. And if you travel around India, you'll see that they're really doing a quite good job in building roads, bridges, etc. But I think that has to be accelerated, because one of the things that's holding back India in terms of even higher growth, even though you've got pretty high growth as it is infrastructure. So more spent on infrastructure would do a very good turn for the Indian economy. So I think at the end of the day, higher than 2% would be very good in my view.
If I can just add as an extension to infrastructure, right? Housing is a big stimulus for the economy. In fact, if you look at India, right, we've seen housing data to be extremely stagnant. In fact, we've had almost a down cycle in the last 6-7 years. While when you look at the developed nations, the housing prices actually have seen sharp upside. So do you have a view on the entire housing cycle? I mean, do you believe that we are at a cusp of maybe a new uptrend post such a longish stagnant phase for housing in India?
Well, one thing is very clear. Indians will be moving from the countryside into cities. Cities will grow. That means more and more housing will be required in Indian cities. This is very, very important. I mean, I know that some people in government and in industry would like to keep people in the countryside, but that's not going to happen. People are definitely going to gravitate to the cities because they can earn more money working in cities. And that requires more housing. So I see there's going to be a continuous surge in demand for housing in cities. And companies that are able to meet that demand of low-cost housing will do quite well.
Okay. Mark, I mean, in the current context, right, if we move forward, there are two broad themes that are emerging in India. One is the entire tech side, and the other is manufacturing, right? We have seen technology getting adopted across the entire value chain, right? With COVID happening, how swiftly we've kind of migrated into a digital method of working, right? In many ways. And we've also on the manufacturing side actually have seen government reforms like PLI under the Atmanirbhar Bharat, right, which is really boosting the manufacturing sector in India, and that really has is giving an impetus to exports. So any specific view you have on these two themes going ahead? One on the tech side, and the second on manufacturing in India.
Well, first of all, no industry anywhere in the world, including India, can get away from technology. And those companies that are embracing technology, whether it be manufacturing, whether it be food industries, whether it be medicine, whatever industry you want to talk about, the degree to which they use technology will be a factor in deciding whether they survive. So you really can't really separate technology alone. You've got to really integrate that into industry in all its aspects. And by the way, one area which we should include in addition to technology and manufacturing or industry is services. You must remember that services will be growing at a very rapid pace in India. For example, just in the medical testing area, the service of medical testing is growing at a very fast speed. Education is growing at a very fast speed. And all of these services are also dependent upon innovations in technology. So I always tell people, look, if you're looking at a company and assessing whether you want to buy that company, you got to find out what are they doing on the technology front. How are they applying technology to their particular business? Very, very important.
Right. So, Mark, I mean, recently in India, you would have seen a spate of IPOs happening, and a lot of these new age, tech players getting listed, right? Many of them are in a growth phase where profits haven't really come in. So, what's your view on it? I mean, are you buying into these stocks or these opportunities from your portfolio as well?
No, we don't buy into companies that are not earning money. We want to buy companies that are actually earning. Now, I realize that people have made millions, if not billions, in some of these companies that have gone public and they've made an awful lot of money. A good example of that is if you look at the history of PayPal, read that history, they went public when they were not earning any money. But what they were excited about, what the public was excited about, was the increase in the number of people using PayPal. And the reason why more people were using PayPal is because the company was paying them to use it. Every new customer meant a loss for the company. And that's true of other companies. The recent IPO of Grab is probably a good example of that, where the company continues to lose money, but they're very excited about the growth of users. So that game can be played if you have a bottomless pit of money, like SoftBank. SoftBank would be a good example of that. But if SoftBank runs out of money, or the other backers of these companies run out of money, then you're in trouble. So I'm not advising people not to look at these companies, but from our point of view, we don't want to get involved in that unless we were doing private equity. If we do in private equity, then we're in before the IPO. Okay, that might be interesting. But as a public equity investor, we don't want to get involved in these companies.
Right. And any view on the disruption that we see in the automobile sector, given that EVs is the norm going forward from here on? Do you believe that the Indian automobile players are really prepared, also from an infrastructure perspective, right? The entire charging infrastructure and all?
Well, generally speaking, it's very similar to what you see in the US. GM, Ford, these companies were really not ready. And the problem they face is they have this huge infrastructure of internal combustion engine manufacturing, and they don't want to give up on those things. So you have a Tesla come along and say, look, I don't want any of that. I don't have any of that. And I'm just going to focus on electric vehicles. And they have an advantage in doing that. And of course, the public is excited about it, and they give them money to grow. And there you see this situation where the valuation of Tesla is much greater than the counterparts in the internal combustion area. So I think if you look at the German car companies have adopted very aggressively electric vehicle technology, but they also have a fight on their hands to get rid of the internal combustion engine. And I think that's true of the Indian companies. Indian companies have to really think about what the opportunity is and move very, very quickly into EV. The problem facing the industry, however, is that there are many new players coming in. So the competition has become very fierce. And that is going to be good for consumers, but probably not very good for those people in the industry.
Right. Mark, if I just move ahead, right, when we look at the big picture, big story, right, there are big opportunities. But from a risk perspective, the singular risk that we see today is the rising inflation in US, right, which is inched up to upwards of 6% today. And there is a expectation of, normalization of the monetary policy by Fed, right? And if we see consequent to that, the dollar index has also strengthened. So do you really believe that Fed may increase interest rates much before what the markets are expecting, right? Because market has already built in certain expectation, but I think the inflation in US has really surprised many. And it definitely will have an impact on the emerging markets. So, your comments here?
Well, as you know, in my book, I mentioned the importance of money supply. The CPI statistics, the normal inflation statistics, are very wrong. They're quite not a good reflection of actual inflation. And if you look at money supply in America, it's been going up 20% plus. So you can expect a devaluation of the dollar in that order and inflation in that order. Now, the good news, of course, is technology is pushing down prices, increasing the value of goods and services, and decreasing manufacturing prices and so forth. But at the end of the day, you've got to expect much higher inflation. The good news is that the Fed so far has been very, very cautious in making measures which could dampen the market and dampen the economy generally. So I think they're going to be very, very slow in increasing interest rates, particularly now with talk of new variants of COVID and that sort of thing. So, of course, nobody can predict it. I mean, they could tomorrow raise interest rates, but my guess is that they're going to be very cautious in doing so.
Right. And another global player really, that can play a big spoil sport is really China, right? Especially in light of what's happened in the entire real estate market there, and then, the various regulations on the internet companies in China. So, Mark, since you track, emerging markets so closely, maybe you may just want to tell our investors what's your view in terms of what's really happening in China. One, that, and second, in context of that, do you believe that India could be a beneficiary, in that light?
Well, India already has been a beneficiary of that, because you must remember that at least 50% of investors in emerging markets follow the index. They're buying ETFs, exchange traded funds. And of course, China, being such a big part of the index, has dragged down that emerging markets index. So people looking at that and say, gee, I want to get out of China, where can I go? And India is an obvious alternative. Of course, India is a much smaller market, less liquid in many ways, but generally speaking, I believe India has already benefited from this downturn in China, because people are going to realize that maybe we should put India and the other emerging markets in one basket and China in a separate basket. So that's one side of the equation. The other side is the general situation in China is being impacted by two major forces. One is the increase in regulation. Actually, the Chinese authorities have been quite lenient. They have not cracked down on monopolies to any great extent, unfair trade practices and so forth. Now they're doing that. That's why they're going after Alibaba, Tencent, and some of these big companies. By the way, it's not all bad because it's good for the smaller and medium-sized companies that will benefit from better regulation where, the big boys will not be able to dominate so much as they did in the past. The other big issue is the U.S. The U.S., as you know, is insisting that Chinese companies hand over their internal financial statements, and the Chinese don't want to do that. I think that will eventually be worked out at the end of the day, but it is driving a lot of people to dump Chinese stocks that are in that position. As you know, one of the techniques that Chinese company used was to have a BOE structure where they have a Cayman Islands company that represents the company but does not get involved in the direct earnings of the company, so they can get away from the restriction that Chinese have in allowing people to have access to the internet stocks. So this is another big issue that is driving Chinese stocks down. How it's going to be resolved is a big question. But in the meantime, it's very bad news for people holding Chinese stocks, at least the big ones.
Right. In fact, Mark, this is a live session that's going on, and it's being streamed live across all our social media platform, and we are getting a lot of questions. So I'm going to maybe read out one or two of them for you to answer.
Sure.
So one of it is, do you like the pharma space themes around COVID? And do you sense an opportunity? The other very related to this is largely in terms of post-COVID, what are the sectors that you prefer?
Right. Well, as far as the pharma sector is involved, as you know, companies like Pfizer, the stock price has gone through the roof as a result of the success they've had with COVID. But I would warn people to be very cautious about that. Pick pharma stocks that are not necessarily dependent upon COVID vaccines or anything like that, and get companies that are more focused on treatment of people who have already caught a virus. I think that's an area which could be quite exciting for Indian companies. So that's one area. So don't expect the pharma companies in general to go up needlessly. However, the other area in the entire healthcare system would be testing. Companies that are doing testing and evaluation of blood samples, of saliva samples, that sort of thing. I think that is going to be a sector that is growing and will continue to grow going forward because people are going to be more and more conscious of their health and will want to know exactly what is the status of their health. So that's, generally speaking, what I would look at. In terms of sectors, as I mentioned, testing is very, very important for us. Education is another area that's important for us. And certain kinds of manufacturing, particularly manufacturing related to home care and home maintenance. That will be an area which I think will grow. And as I said, there's going to be a continuing demand for housing, particularly low-cost housing.
Right. One related question again, Mark. This is on Twitter. Any PSU stocks that you like, especially with government's renewed focus on privatization? Any commentary on the entire PSU basket that you have?
Well, I think, the privatization program is very, very important and very good. I would not necessarily go after any of these stocks until it is very clear what percent the government is selling and how the management will be changed, if changed at all. So I think that's the corporate governance aspect is very critical before looking at these companies.
Right. Moving on now, Mark, you are a proponent of gold. You speak about it as from an asset allocation perspective. So, do you think that we've really made a bottom in this asset class? And especially, do you see it gaining more allocation from the central bank for the reserves?
I think it will gain more and more popularity going forward because people are now beginning to realize that maybe the cryptocurrencies could have problems. So they may be switching, instead of having a virtual Bitcoin, they want to have a real gold Bitcoin as pictured in the magazines. So I think gold will always be with us, will always be a form of currency. And as I point out to people, a lot of people say, oh, isn't this gold the same as Bitcoin or cryptocurrencies? And I tell them, cryptocurrency you can't wear on your wrist and you can't use in semiconductors as connectors, but gold you can. So gold has some real uses in addition to be a store of value.
Right. So from an asset allocation perspective, what kind of allocation would you kind of recommend, Mark, to an investor who's wanting to build his portfolio?
Well, I would put 5, maybe 10% in gold, and the rest, because I'm assuming people have their own home. Number one, of course, you have your own home paid for fully, so you have a roof over your head. That's very important. And then maybe enough savings in cash to take care of 1 year's of expenses. After that, everything should go into equities, and not only Indian equities, by the way, but global equities, and about 5 to 10% in gold.
Right. Also, Mark, if you could maybe, it's always intrigued people in terms of the dilemma that investors have, which is between, trying to invest into value stocks versus growth. Would you want to maybe throw some insight here from your side?
Yeah, I've always wondered why people make this distinction, because whenever we look at a stock, we want a stock to be cheap in terms of its assets, okay? But we also want a stock that will be growing. It's no sense buying a stock that has no growth prospects. So you need both value and growth in that sense. So for example, when I look at a stock, one of the first things I ask is, what is the return on their equity? In other words, what are they earning on the amount invested in this company? That would be a value criteria, I would say, okay? But then the next question I ask is, what is their debt? Again, the value criteria. We don't want companies with heavy debt. And the third question is a very important question. What are the earnings growth prospects? And that would be the growth criteria. So you need the combination of growth and value when you're making investments. And it's probably not a good idea to differentiate between those two criteria.
Right. I am also being flooded by a flurry of few more questions, Mark, and I'm going to read it out.
Sure.
And one of it is from a global perspective, are there any specific sector themes that you like and that you think that clients should definitely have an exposure to that?
Well, I mentioned already the education area, which is growing very fast, particularly in emerging markets. I mentioned this medical testing and that sort of thing. Medical supplies would be another one. But then one of the things I didn't mention, which is very important, is technology, hardware, and software. In other words, companies that are doing enterprise software and companies that are doing computer hardware, particularly chips. As you know, there's a worldwide shortage of semiconductors, or so-called chips. And those companies are doing very well. And companies that supply the semiconductor industry with software and that sort of thing, testing, are doing very well and will continue to do well because our world is now being taken over by semiconductors. I mean, if you look, I was really surprised to learn a while back that automobiles use more semiconductors than a normal laptop computer. So we're going to see more and more use of semiconductors in every aspect of our lives.
Right. Yeah, Mark, I mean, from an Indian perspective, right, there is a strong tailwind for the Indian growth story. There is expectation of strong growth, EPS that, we kind of discussed. But India has started commanding, from a valuation perspective, rich valuation, both in comparison to other markets as well as, its own historical averages. And recently, we've had a couple of brokerage houses, coming out with reports on downgrade on the Indian equity market. So do you really have, concerns on the entire valuation that you see in India?
No, I think what's happening is that the industry is looking at various factors such as price earnings ratio. So they say, God, the stocks used to be at 5 times or 10 times earnings, price earnings ratio. Now it's 20, 30, 40, 50 times. But they must remember that, again, when I mentioned the growth aspect, if you have a company that's growing at a fast pace, it will justify having a very high PE ratio. So in a case like India, where the growth is so good, you can justify a high PE. The other factor is interest rates. If you have interest rates that are zero, like you have in Europe today, the PE ratio, the rationale for PE ratio goes out the window because the reciprocal of zero can be anything. If the interest rates are 5%, the reciprocal is 20. So the PE ratio can be 20 times and so forth. So you've got to take into consideration all of these factors, the growth and also interest rates. And from that standpoint, India is in pretty good shape because the growth rate is very high. Okay, interest rates may not be that low, but in fact, they are not excessively high.
Right. So from an investments perspective, Mark, I mean, are you fully invested in India or have you kept some dry powder left? How are you really building your portfolio?
We're now fully invested in India. We have about 20% of our portfolio in India. We also have about 20% in Taiwan. And in other countries, we have, China, it's like 10% and so forth. We have a number of other countries in which we've invested. So we're very, very heavy in Indian stocks, and they've been doing very, very well, I must say. So it's helped us a lot. Now, whether those percentages can change depending on where the prices go, but I believe we will probably continue to have that kind of weighting in India. It depends on the individual stocks, of course.
Right. Just 1 second. I'm just looking at our Twitter handle. There are 2 questions on sectors, Mark. I don't know, while you've kind of spoken about the big themes that you're looking at, people are asking, one on the Indian banking sector and second on your theme on the entire agriculture or agri-goods theme, the rural theme, the Bharat theme, really, and how do you see that as an opportunity?
Yeah, as far as the banks are concerned, we're not into the banks globally because we're focusing on the medium-sized companies, medium and small companies, because we want companies that are going to become big. And if you look at banks are big. They're already big and very, very heavy weightings in the index and so forth and so on. The other factor with banks is they're very, very difficult to assess because the key factor is the non-performing loans. And if you ask any banker, you'll say, oh, my non-performing loans are very low. So it's very difficult. Of course, they're being honest. They look at their loan portfolio and say, well, I think this guy's going to pay, that guy's going to pay back, this guy's going to pay back. But if someone else looks at them and say, no, this guy may not pay back. So you've got to take this non-performing loans ratio with a grain of salt when you look at banks. But I'm not saying that banks are not completely out of the picture, particularly banks that are diversified into other services like insurance and so forth and so on. And banks that have embraced fintech will do fairly well. But we are still keeping an open mind with banks, but currently we don't hold banks because of the size are bigger than what we're looking for.
Right. Mark, I mean, what's your, because, the entire liquidity has really been, and thanks to central bank, we've got $10 trillion of liquidity that really, was pumped in. How do you see liquidity going forward from here on, and its implication on the markets?
That's a big question mark, because as you know, countries around the world have been pumping liquidity into the system because they want to keep the economies alive in the face of the COVID. And America has led the way. The US, as I mentioned, money supply has gone up by 20% plus. I think that will end. I think the amount that they're pumping in will stop. They may not necessarily try to withdraw much, but they will not be increasing the money supply. And of course, that will have an impact on the markets. So you will see a temporary lapse in the market growth as a result of that. But you must remember, there are all kinds of liquidity that are available in the system besides central bank liquidity. And the banks still are sitting on lots of cash. And I believe you will see this money coming out as well. So this is one thing we have to watch very carefully, because a dramatic downturn in liquidity will not be good for markets.
Right. And Mark, I mean, if you could throw some light on the FII activity and what kind of allocation are they doing, if you have a view?
Yeah, well, as you know, because of this downturn in China, some investors have reduced their exposure to emerging markets because they're buying ETFs and they're not happy with what the index is doing. But India, I think, has become more favored among those who are still in the emerging markets arena because they see value and they see growth. And they see, of course, the performance has been good. So I think you're going to still see flows coming into the Indian market.
Right. Last two questions, Mark. First, what have you learned from the stock markets, or what are our learnings in 2021 as we are, nearing close of the year? And second is that, what is it that as an investor one needs to look at as one enters 2022?
Well, one thing we've learned is that markets can recover very, very quickly. If you look at what happened in February, March of last year, this big downturn, and now an incredible bull market that's lasted all the way through this year and will continue probably to the end of the year. Now, what you have to keep in mind is that bull markets normally last about 3 years, and there'll be corrections along the way. So one of the things we have to look forward to next year is a correction in the market. I'm not saying a long bear market, but a correction. One of the things that we have to look very carefully at is the whole cryptocurrency area, because that has become so huge and so many retail investors have depended upon that market. Any dramatic downturn could affect market psychology generally. So I would expect the regular equity market to react to that, probably turning down as well. But as I say, these will be corrections, not entering a long-term bull market.
Right. Mark, while you've kind of answered it, but I'm getting a lot of questions on the US inflation. So I'm going to again read out maybe one more question that's come in, which is largely on inflation at the 30-year high. Is there a risk of peak contraction for global equities as yields increase and the cost of capital in general has gone up, right? So maybe you may just want to elaborate further on this.
Yes, I mean, as I mentioned, you have to look at, it's not exactly an exact measure, but if interest rates in America go up, of course, the viability of a high price earnings ratio is not there. So that's one thing you have to look at very carefully, because if people, for example, can earn 5% or 8% or 10% at the bank, earnings in the bank is interest, then the attractiveness of stock market investment becomes less. It goes down. So that's one thing you have to look at very carefully, is not only what the central banks are going to do, but what is going to happen to the retail investor in terms of their earnings with their savings in the bank. So, for example, I was recently in Turkey, and I was talking to a cab driver. I said, "Where are you putting your money?" He said, "I'm putting it into cryptocurrencies." I said, "Why?" He said, "Well, because I'm not getting a good interest at the bank, and I can make more money with cryptocurrencies." So this is a situation that you see in different parts of the world.
Right. Mark, my penultimate question, if there is one message that you would want to give to our investors, and there are hundreds of them, who have joined in various handle listening to this session live, what would be that message from your side?
First of all, don't get excited. In other words, don't listen to rumors. Don't react impulsively when someone says the market is going down and there'll be a crash and the world is coming to an end. Sit down, think clearly, and look at the facts and make decisions on basis of your own examination of the facts. This is very, very important when you're an investor. You have to keep cool and steady, and take a long-term view. Don't take a short-term view. Don't speculate on a daily basis, because usually day traders, for example, end up in misery because it doesn't work in the long term. So that's what I would advise. People, be patient, make decisions based on your own initiative and your own knowledge and research. And if you don't have time to do that, invest in good funds. ICICI probably has a whole battery of very good funds that you can invest in.
Thank you, Mark.
No, stay with them in the long term. Don't go in and out. That's the key point.
And and my last question on the markets commentary, Mark, is if people would have to be watchful of, what is the risk that you see for this markets, given that 2021, 2020 post-COVID has been really fantastic. Even with elevated levels, 2021 calendar year also has been great for the markets and in India in general. So if people were to be wary of one risk, what would that be?
Well, I mean, if you look at this whole situation with COVID, I believe that people are beginning, as I said, getting inured to the idea of new variations and so forth. So the impact on the market will not be as great as it was last year in February, March. So going forward, we can expect more variations, more news about this and so forth. But eventually, the governments will have to give up and open up their economies. They cannot continue this current lockdowns and so forth.
Right. Great, Mark. I mean, it was great hearing you. My last question really, and it's got nothing to do with the markets, right? On a very personal front, I mean, you are what, 85?
Yeah.
And I wonder, I mean, how do you keep on being so active? I mean, I hear you travel all over the globe, right? And you've been active in markets, you're researching companies and finding new ideas. I mean, what keeps you going?
Well, the work keeps me going. I love the work I'm doing. I love the research. I love investing. I think that's what really keeps me going. And of course, trying to keep healthy. I mean, exercising every day, try to eat healthily. Of course, I'm not great at that. I love sweets, but that's another issue. But try to, as much as possible, keep the weight down and be optimistic. You know, the world belongs to optimists, not pessimists.
Right, Mark. Thank you so much. I mean, it was such a pleasure talking to you. Right. Wonderful. And thanks for joining in Investonomics. Thank you so much.
Thank you very much. It was a pleasure. Thank you.
Thank you. Thank you, everybody. With that, we come to a close of our session. Thank you.